Today, we're doing a complete breakdown of Indian Accounting Standard 38. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying Indian Accounting Standard, prepping for a Big Four interview, or working in finance, this is everything you need to know. Brands, patents, and intellectual property were once invisible in financial statements, creating gaps in asset valuation. Indian Accounting Standard 38 changed the game, allowing companies to capitalize intangible assets like software and branding, transforming unseen value into reported assets. You'll discover how this standard ensures accurate representation of intangibles, impacting investor decisions. Indian Accounting Standard 38 exists to bring consistency and clarity to the accounting treatment of intangible assets. Before this standard, companies had the challenge of inconsistent reporting, leading to undervaluation of crucial assets like patents and trademarks. By defining clear criteria for recognition, it ensures intangible assets are appropriately represented on balance sheets, aligning reporting practices across industries and providing more accurate financial insights. This standard applies broadly to entities using Indian Accounting Standard, effective since April 1, 2016. A crucial requirement is the recognition of intangible assets when it's probable they will yield future economic benefits, and their cost can be reliably measured. For instance, a company developing software must show potential revenue streams and accurate cost measurement before capitalizing the asset, ensuring financial statements reflect true economic value. The recognition and measurement model under Indian Accounting Standard 38 requires intangible assets to be initially recorded at cost, including all directly attributable expenses such as import duties or development costs. Companies then choose to either amortize the asset over its useful life or revalue it, ensuring that financial statements reflect a realistic and updated valuation. This approach is crucial in interviews, showing a clear understanding of how intangible assets should be managed and reported. Scope is crucial when applying Indian Accounting Standard 38. Many candidates mistakenly include goodwill arising from business combinations, which is explicitly excluded from this standard. Remembering exclusions can save you from common interview traps. Misunderstanding scope can lead to misclassification of assets, affecting financial statements. Clear understanding ensures accurate reporting and compliance. Indian Accounting Standard 38 encompasses intangible assets like research and development costs, provided they meet certain criteria for capitalization. Patents and copyrights are classic examples. Both are identifiable and offer future economic benefits. Trademarks and brand names, when generating future benefits, fall under this scope. Recognizing these correctly is pivotal for accurate financial reporting. Indian Accounting Standard 38 does not cover goodwill from business combinations, because it's not an identifiable intangible asset. Financial assets are excluded due to their monetary nature. Deferred tax assets governed by tax-specific standards and inventory, a physical asset, are also outside this standard scope. Understanding these exclusions prevents common errors in asset classification. An intangible asset is a non-monetary asset without physical substance, yet it must provide identifiable economic benefits. Patents exemplify this. They lack physical form but grant valuable rights. These assets, separable or arising from legal rights, must be identifiable. For instance, a patented technology fits this definition, offering future monetary gains through exclusivity. Recognition in Indian Accounting Standard 38 means including an intangible asset in financial statements when specific criteria are satisfied. Future economic benefits must be probable, and costs should be measurable. For instance, development costs become capitalized when a project shows probable success and can be measured accurately. This ensures only viable projects affect financials. Navigating scope edge cases can be tricky. Licensing a patent fits within Indian Accounting Standard 38 due to the identifiable nature of the asset. Goodwill from mergers isn't covered. It's not identifiable. Development costs for a promising app, however, are included if benefits are probable and costs are clear. Brand loyalty programs typically don't meet the identifiability criteria, thus are excluded. These distinctions are crucial for precise financial reporting. Intangible assets like patents and software licenses often go unnoticed, impacting financial transparency. The recognition and measurement model ensures these assets appear clearly on balance sheets, affecting valuations and investor decisions. In today's knowledge economy, identifying and valuing such assets is essential for accurate financial reporting. The recognition and measurement model ensures intangible assets are valued clearly on financial statements. Our example involves Meridian Corporation's $10 million 3-year SaaS contract with Acme Incorporated, including an $8 million software license and $2 million in services. Watch as we apply each step, transforming these figures into financial statements. Identifying intangible assets requires understanding what lacks physical form but has value. For Meridian Corporation, the $8 million software license becomes the intangible asset. This step establishes the foundation. Misidentifying such assets leads to financial inaccuracies. Key is recognizing control over the asset's future benefits, essential under Indian accounting standard. Recognition requires that the intangible asset be identifiable and controlled, offering future economic benefits. For Meridian Corporation, since the software license grants control and expected benefits, it meets recognition criteria. Missteps often occur when companies overlook the control aspect. Indian accounting standard insists on these criteria to prevent misstatements. The asset's control now leads us to cost measurement. Cost measurement involves the purchase price and costs directly attributable to preparing the asset for use. For Meridian Corporation, this means the $8 million software plus $2 million implementation, totaling $10 million. Frequently, firms overlook direct costs, misrepresenting asset values. Indian accounting standard ensures all related costs are captured, setting the stage for assessing useful life. Assessing useful life involves estimating the period the asset provides benefits. Meridian Corporation aligns this with their 3-year SaaS term. A common mistake is ignoring technological obsolescence, skewing amortization. Indian accounting standard mandates periodic reassessment to mirror true economic conditions. Here, the 3-year life guides amortization and impairment testing. Amortization spreads the asset cost over its useful life, requiring annual impairment tests. Meridian Corporation divides the $10 million across 3 years, ensuring checks for value loss. Skipping impairment tests leads to overvalued assets, a common mishap. Indian accounting standard insists on regular assessments, keeping valuations accurate. With this, Meridian's asset story concludes, balancing precision with compliance. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. Indian Accounting Standard 38 offers 2 main measurement choices: cost or revaluation. Disclosures are crucial for transparency, affecting how investors perceive your company's intangible assets. When recognizing intangible assets, the key is to ensure future economic benefits are probable and costs are reliably measurable. For instance, if a company purchases software for $100,000, the asset is initially measured at this cost, including installation fees. For assets from government grants, fair value dictates initial measurement, showcasing how funding sources influence asset valuation. Ongoing measurement requires choosing between cost or revaluation models. Under the cost model, assets remain at initial cost minus amortization, while the revaluation model adjusts for fair value changes. For example, revaluation can increase an asset's book value from $1 million to $1.2 million, impacting equity but not profit. This choice significantly influences financial statement dynamics and investor perception. On the balance sheet, intangible assets are distinctly itemized, with amortization and impairment reflected in the profit and loss. For instance, software assets valued at $500,000, with annual amortization of $50,000, clearly impact financial results. Detailed notes enhance understanding, covering asset nature and amortization methods. Accurate classification between internally generated and acquired assets is essential for transparency. Disclosures provide vital insights into a company's asset strategy. Stating the useful life or amortization rate helps analysts gauge asset longevity. Impairment losses and reversals reveal financial health shifts, while revaluation methodologies enhance transparency. Separating R&D costs informs stakeholders about innovation investments, often influencing market perceptions. These disclosures collectively offer an invaluable window into a firm's operational dynamics and future potential. Consider a CFO at a tech firm navigating Indian Accounting Standard 38. After acquiring a patent for $1.5 million, the choice between cost and revaluation models is pivotal. Opting for revaluation, the asset appreciates to $2 million, but impairment testing reveals a $200,000 loss. With a $100,000 annual amortization, this strategic decision profoundly affects financial statements, influencing investor confidence and financial strategy. Meridian Corporation, a global manufacturing company, acquires a new patent for an innovative production process for $1,200,000. Follow how each accounting event unfolds as the company applies Indian Accounting Standard 38 to its intangible assets. The patent acquisition is recognized as an intangible asset. Indian Accounting Standard 38 mandates this recognition due to its potential to generate future economic benefits. By recording it at cost, Meridian Corporation accurately represents the acquisition on the balance sheet, ensuring investors see the resource's value. Amortization spreads the patent's cost over its useful life, reflecting its consumption. For Meridian Corporation, annual amortization of $240,000 aligns with the expected 5-year benefit period. Indian Accounting Standard 38 requires this systematic allocation, impacting both the income statement and balance sheet. Impairment testing checks asset recoverability. A $100,000 impairment loss is recorded when the patent's market value drops. Indian Accounting Standard 38 enforces this, ensuring Meridian Corporation's intangible assets are not overstated in volatile markets, preserving balance sheet integrity. Revaluation adjusts the intangible asset's value to match market conditions, with a $150,000 surplus recorded. Indian Accounting Standard 38 permits revaluation when there's a reliable measure. This enhances the transparency of Meridian Corporation's financial statements, crucial for stakeholder trust. De-recognizing the patent concludes its life cycle in Meridian Corporation's books. Accumulated amortization balances out the asset's initial cost. Indian Accounting Standard 38 guides this disposal, marking the end of amortization and ensuring the financials reflect reality as the asset exits. Every Big Four and investment bank interview on Indian Accounting Standard 38 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. An intangible asset is a non-monetary asset without physical substance, identifiable as separable or arising from contractual rights. Indian Accounting Standard 38 requires it to be controlled by the entity and to provide future economic benefits. A typical mistake is confusing intangibles with tangibles like machinery. Remember, identifiability and future benefits are key. Indian Accounting Standard 38 exists to prescribe the accounting treatment for intangible assets, not dealt with specifically in other standards. Its purpose is to ensure that the recognition, measurement, and disclosures provide users with financial statements that are clear and consistent. A common pitfall is ignoring the need for consistent application across periods. Key takeaway: consistency and transparency. During development, costs are capitalized if certain criteria are met, including technical feasibility and intention to complete. Unlike research costs, which are expensed, these development costs become part of the carrying value. Mistakes often include capitalizing research costs. Remember, strict separation between research and development phases is crucial. Indian Accounting Standard 38 aligns closely with International Financial Reporting Standards 38, but differences exist in certain measurement aspects, like revaluation models, which may be less commonly applied in India. Recognition criteria remain largely the same. Common errors include misunderstanding revaluation frequency. Key takeaway: careful attention to localized application is essential. Impairment testing involves comparing the carrying amount to the recoverable amount. The higher of value in use or fair value, less costs to sell. It's crucial to assess at least annually or when indicators suggest impairment. A frequent mistake is ignoring triggering events. Takeaway: vigilance in monitoring asset value changes. Development costs can be capitalized once specific criteria are met. Technical feasibility, intention to complete, ability to use or sell, future economic benefits, and reliable cost measurement. Mistakes often include premature capitalization, Crucial takeaway: only capitalize when all criteria are clearly satisfied, ensuring asset validity. Indian Accounting Standard 38 excludes goodwill, mineral rights, and financial assets since they are covered elsewhere. Overlooking this can lead to misclassification and errors in financial statements. The error often stems from inadequate scope understanding. Key takeaway: understand what falls outside Indian Accounting Standard 38 to ensure proper standard application. Indian Accounting Standard 38 permits the revaluation model but is less frequently applied due to valuation challenges in India. International Financial Reporting Standards allows more flexibility in frequency of revaluation. Misunderstanding local revaluation practices is common. Remember, be aware of practical challenges and how they affect valuation policy implementation. Under Indian Accounting Standard 38, disclosures include asset description, amortization method, and impairment losses. The CFO must disclose reconciliation of carrying amounts and circumstances of impairment. Common pitfalls include incomplete disclosures. Essential takeaway: comprehensive and transparent disclosure is critical for investor confidence and regulatory compliance. Software development is covered under Indian Accounting Standard 38 when it meets the criteria for capitalization. Confusion arises because some aspects may fall under expenses, leading to recognition errors. The trap often lies in misjudging when to capitalize development costs. Remember, criteria-based assessment is vital for correct treatment. Indian Accounting Standard 38 targets how we account for intangible assets like brands and patents. Its scope excludes goodwill. Recognize these assets when future economic benefits are probable and costs measurable. Intangibles should be non-monetary, identifiable, and lack physical substance. They can be carried at cost, less amortization and impairment, or if active market data exists, revalued. The distinction between these models is vital for financial consistency. To recognize intangible assets, future benefits and cost measurability are crucial. Use cost model unless an active market allows revaluation. Allocate amortization systematically over finite useful lives, while indefinite lives skip this. Impairment checks are necessary if signs emerge. Residual values are typically zero unless exceptions apply. These principles ensure consistent and reliable financial reporting, crucial for accurate valuation and investor confidence. Understand the subtle differences between Indian Accounting Standard 38 and IAS 38, but focus on consistent principles. Avoid revaluation traps by confirming active market existence. Disclose changes in carrying amounts and justify indefinite life decisions. Clear amortization policies and impairment considerations are crucial. Accurate residual value assumptions prevent misstatements. Recognizing finite versus indefinite life assets impacts amortization practices and financial transparency, essential for interviews and practical application. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.